Jamila, yesterday we did question two, and today I'll be doing question three, still on fixed assets. We have extracted balances. The 1st of March 2023 is the beginning of the financial year. We are given the cost there at the beginning of the financial year. The cost price for vehicles will be 1,420,000 and accumulated depreciation is 688,000. Those are the balances at the beginning of the year. When it comes to the end of the year, which is the 29th of Feb 2024, I couldn't help but notice that the cost price of vehicles has gone up. Now, the fact that it has gone up, it means we bought a vehicle during the year. Now, I wouldn't know if we sold a vehicle or not, but one thing I can tell you is that we bought a vehicle. And what tells me that we bought a vehicle is because the cost price has gone up. And then it says the following transactions relate to the vehicles for the year ended 29th February 2024. And they say here an old vehicle which had an initial cost. So this is the cost price of a vehicle, right? Was traded in. To trade in means that we substituted it for another vehicle. Okay. On the 1st of December 2023, highlight that. So this is when we stopped using the old vehicle and it was traded in for 92,000 Rand cash. So let me write what been given here. First of all, we are given the cost price of the vehicle sold. We are also given the selling price of the vehicle sold. We are also given the date of sale, which is the 1st of December 2023. The carrying value, that is worth highlighting. The carrying value of the sold vehicle on the 1st of December was 112,000. Normally, they never give you that. Surprisingly, they gave it to you here. Then they want us to calculate the rent value of the new vehicle on the 1st of December 2023. Vehicles are depreciated at 15% using the cost price or fixed installment method. Hmm. One thing I haven't written here is that this 112,000 is actually the carrying value. You have the carrying value, you've got the selling price. It's so easy for you here to calculate whether you've made a profit or loss. It's evident that we've actually made a loss. We've incurred a loss. That is because the selling price is lower than the carrying value, which is the value of the asset. What they want here is this. So the first question requires us to calculate the cost price of the new vehicle. We need to calculate the following amounts relating to fixed assets in the space provided below. We need to calculate the cost price of the new vehicle on the 1st of December 2023. They want us to calculate accumulated depreciation relating to the vehicle sold. I need to highlight that. We also need to calculate depreciation for the year ending the 28th of February, which is made up of the old vehicle sold, new, and the total. The last part requires us to calculate the carrying value of vehicles on the 29th of February 2024. I'm going to start from the beginning. One thing I have noticed is that when it comes to the cost price of vehicles, we are simply given this information here, which will be very important. They gave us the cost price at the beginning of the year and the cost price at the end of the year. And also gave us the cost price of the vehicle that was sold. The only thing that they didn't give us is the cost price of the vehicle that was purchased. So in a situation like this, what I will do is to reconstruct my tangible asset note. You can do the T account if you want to. It still works perfectly. I think T account will be actually better than what I'm going to do now. But because I know you guys struggle a lot with T accounts, I just prefer to use tables. Note that here I am reconstructing the tangible asset note, but I'm only using cost. Remember, you have cost at the beginning of the year. So I'll have beginning of year cost. So I will just write it as beginning of year, which was given to us. It was 1,420,000, right? We're gonna have additions here, and your additions will always be at cost price, and that'll be X because it was not given to us. Then we're gonna have disposal. Unlike what you are used to, here our disposals will be at cost price, and that is because everything that we're doing here is actually at cost price. That is cost price at the beginning. This is cost price of additions. So you're gonna have cost price of the disposal. The disposal, though, you will put it in brackets. So the cost price of the asset sold, you will put it in brackets, which was 270,000 Rand. Let me confirm that. I'm not exactly sure about it. Yes, that what it is. Okay. And then we're gonna have end of year balance. End of year balance is the one that I told you about, which was what, 1,700,000. You will notice that for me to get that cost at the end of the year, I need to have cost at the beginning of the year. You add your additions, you minus your disposals, and you should get cost at the end of the year. You will have to work backwards here. To work backwards, you will take that 1,700,000, add what you subtracted, which is that 270,000, and minus what you added, which is that 1,420,000. Please get busy on your calculators. Do it quickly. So in your calculator, what you will have is you will simply take that 1,700,000. Okay, and you will add the 270,000 and minus 1,420,000. It gives me the cost price of 550,000. Is that what you got? So it gives me the cost price of 550,000 Rand. Okay, highlight that. Very important. That's what they wanted us to calculate. That will be the cost price of the new vehicle on the 1st of December 2023. The next question requires us to calculate accumulated depreciation on the 1st of December relating to the vehicle that was sold. What do we have with respect to this vehicle, and how do we calculate accumulated depreciation? Please note that to calculate accumulated depreciation, you need accumulated depreciation at the beginning of the year so that you can calculate depreciation for the current year, add them up, and get accumulated depreciation on the date of sale. I can't do that here because when it comes to the vehicle that was sold, they did not give us accumulated depreciation of this vehicle at the beginning of the year. It was not given to us. So even if I take the 270 and I multiply it by 15%, I get current year depreciation. I still need to take that current year depreciation and add it with the accumulated depreciation of the vehicle sold at the beginning of the year. I can't do that. It's not given to us here. So what option do I have? I notice that I've got the cost price, right? I've got the carrying value. And that actually gives me a solution to this problem. Because for me to calculate accumulated depreciation, all I need is the cost price, which is that 270,000. I need the cost price of 270,000. I also need accumulated depreciation, but I don't have it. It's X, and that should give me the carrying value, of which was given to us, by the way. They were very nice here. So the carrying value is 112,000 Rand, right? And normally you will subtract your accumulated depreciation to get the carrying value. So what we know is that if I take that 200 70,000, right? If I take the 270,000 and I minus my accumulated depreciation, I should get the carrying value of 112,000 rand. So to solve for x here, I'll just take x to the other side and then I'll take 112 to this side. So I'll have 270,000 minus 112,000. So this 112, when you put it to this side, it'll be negative. This x, when you transpose it to the other side, it'll be positive, okay? And this will give me my accumulated depreciation value. Do it in your calculator. Take the 270,000 and minus 112,000. You will get 158,000. That 158,000 will be the accumulated depreciation of these assets that was sold at the date of sale. Okay, so this will be the accumulated depreciation of the assets sold on the 1st of December 2023. There we go. Done. Right. The next question, they want us to calculate depreciation. We will have to start with the old vehicles. Guys, when it comes to the old vehicles, I I can only be able to use the opening balances because opening balances are accumulated amounts from the previous years. So the old vehicle is right there, and I will split that. Okay, I will start by splitting that 1,420,000. Normally, you take the cost of all vehicles, you minus the cost of the vehicle sold. Only the vehicle sold was in there. The new one was not there because it was not there at the beginning of the year. Right. So what do we do here? I'm going to start with my financial year. I will just write it here at the bottom. It starts on the 1st of March 23, right? March, April, May, June, July, August, September, October, November, December, January, February. So this February will be 2024. And we know that this vehicle here, the one that was sold here, all right? So the one that was sold here. So we actually used it from the beginning of the year up until there. So the one that was sold, we only use it for 9 months. Okay. And then we've got the new asset. So the new asset was bought here, right? So the new vehicle was bought here and was only used up until there. So this one, we're gonna depreciate it for 3 months because we've only used it for 3 months. Okay, because it was used from the 1st of December up until the end of Feb. The reason why we depreciate only for 3 months because we depreciate for as long as we use. So that one, we've only used it for 3 months. So there's 3 months out of 12 because depreciation is 15% per annum, which is for the whole year. So to apportion it, you will multiply that by 3 and divide it by 12. We good. We together. When it comes to the whole vehicle, guys, the first thing that I'm going to do things first, I will let me just do it in this color. I will take the cost price. The total cost price that was given to us was 1,420,000. I will minus the cost price of the vehicle that was sold, which is 270,000. Now, your calculator quickly. 1,420,000 you minus 270,000, it gives you 1,150,000, which is the cost of the remaining vehicle. I also need accumulated depreciation of the remaining vehicle. So I'm going to take the 688,000. Okay. I need to minus accumulated depreciation of the vehicle that was sold. But I don't have it. I only have accumulated depreciation on the date of sale, which is right there. Now, this will change things a little bit. Okay, so because I only have accumulated depreciation here, and we calculated that accumulated depreciation, we said it was it was given to us, I know that for sure. We calculated it as 158,000. So we know that when it comes to the vehicle sold, its accumulated depreciation here was 158,000 Rand, right? However, that 158,000 Rand included current year depreciation. And current year depreciation of the new vehicle was you were supposed to take the 270,000 and you multiply it by 15%, and then you multiply it by 9 over 12, and this will have given you how much? 270,000. You multiply that by 0.15, you multiply it by 9, you divide it by 12. It was going to give you 30,375. So that is the current year depreciation of the vehicle that was sold, okay? It was only used for 9 months out of 12 months. When you work backwards here, okay, so if we've got depreciation, which was added to get that amount over there, um, it was added to get this amount over here. So what we're gonna do is to work backwards because depreciation was 30,375. If we want to work accumulated depreciation here at the beginning of the year, we're gonna add those two amounts to get no, we're not gonna add them actually. We're gonna subtract the two amounts because we added the opening balance. So what we actually did was that whatever our accumulated depreciation was here, we added it with the 30,375 for us to get that 158,000. Now we're gonna work backwards. When we work backwards, we're gonna have to reverse operation. We're gonna have to take this and minus that 30,375. So you'll have 158,000 minus 30,375. It'll give you 127,000. 625. Now, whatever we left with will just be of the old. Okay, so we do have the cost of the old, which is that 1,150,000. Now we're gonna take 688,000 minus 127,625. We will have accumulated depreciation of the old as 560,000 Rand. No, 560,000. Put it into your calculator, 375. Now you're going to have your carrying value, which will be 1,150,000. You minus that 560,375. It'll give you 589,625. That is the carrying value of the old vehicles at the beginning of the year. But that's not what they wanted from us. Why am I calculating it then? If that's not what was asked, why am I calculating it? It's because when you calculate current year depreciation, which will be 1,150,000 multiplied by 15%, multiplied by 12 over 12, because we're going to use them for the entire year. So the old vehicles, we're going to use them from here up until the, okay? 1,150,000 multiplied by 0.15, it will give us 172,000. So the depreciation of the old vehicles will be 172,000 500. Okay, that 172,500 is the current year depreciation of the remaining or old vehicles. You got that? However, we can't just take it at face value. We always have to compare it to the carrying value at the beginning of the year. If it was less than the carrying value at the beginning of the year, well, it is less than the carrying value at the beginning of the year, we're going to take it as it is. So that is our current year depreciation. However, if it was more, guys, we were not going to take that 172,500. We were going to take the carrying value at the beginning of the year minus 1. We were going to limit it at the carrying value at the beginning of the year minus 1. I know most of you are thinking, why? What the heck? Why are you calculating that carrying value at the beginning of the year? A lot of you miss it. And by not calculating carrying value at the beginning of the year, you go out of that paper thinking you nailed the paper, only to find that it's wrong because you did not check carrying value at the beginning of the year. More especially when you are depreciating using the cost price method. That process is very important. You need to calculate carrying value of the asset at the beginning of the year before you can calculate depreciation for that asset for the current year. This is to ensure that current year depreciation for that asset does not exceed carrying value of that asset at the beginning of the year. Because if it does, you're going to have a negative carrying value, which will not make sense at all. Because carrying value represents the value that the asset will still add to the business, the value of the asset that you can still derive, the value that you can still derive from using the asset. So if it's negative, you're saying there's no value, so why are you still having it? And if it has no value, its carrying value must be 1. It cannot be negative because when you say it's negative, you're saying it's a negative asset and such thing doesn't exist. You got it. All right. Now I have a busy working space here. Now I have to calculate look at what I did. I actually calculated the depreciation of the sold under new. Okay, I'm just gonna put it here. I'm just gonna rewrite it here. So it's 270,000. So then we have 270,000. We times it by 15%. We times it by 9 out of 12. Depreciation of the asset sold was 30,375. So now we need to calculate the depreciation of the new. And I did specify with the new, it's quite easy because you know that it was only used for 3 months. The cost of the new, it was calculated over here, which is that 550,000 rand. So you will take that 550,000 rand, 550,000 rand, and you will multiply it by 15%. We only use it for 3 months out of 12. So that will give us the depreciation here. So take that 550,000 multiplied by 15%, multiplied by 3, divided by 12, it will give you depreciation of this asset, which will be 20,670. No. It's 20,625. So when you add your depreciation for the current year, it'll be this 172,500 plus this 30,375 plus this 20,625. It's because we only use that asset for 3 months. What are those 3 months that we're talking about? It is in red. It was used for December, January, and February. That's why we've got 3. The new asset was only used for 3 months from when it was purchased until the end of year, which is end of year right here. So when you add all of those up, they will give you your total depreciation for the year. So 20,625 plus 30,375 plus 172,500, it gives me 223,500, which is the depreciation on vehicles for the current year. Happy? So that's what they wanted us to calculate here. The next question, what are they asking for? They want us to calculate the carrying value at the end of the year. What you have to do, guys, is to know how to calculate the carrying value. Carrying value will always be cost price minus accumulated depreciation. So the cost price at the end of the year, we don't need to calculate it. It was actually given to us. So the cost price at the end of the year was given to us as 1,700,000. If you're wondering, wait, where did you get that? Actually, guys, I took it from here. It was given to me. There it is. At the end of the year, it's given to me. The problem is that I don't have accumulated depreciation at the end of the year. So now I need to calculate accumulated depreciation at the end of the year. I'll just say AD at EOY end of year will be accumulated depreciation at the beginning of the year, which is 688,000. If you're wondering why I got that from, it comes from here. So that is your accumulated depreciation at the beginning of the year. I'm going to add that with current year depreciation, which is this one here, 223,000. 500. And then I'm going to minus accumulated depreciation of the asset that was sold, which we calculated over here as 158,000. It must be accumulated depreciation of the asset sold at the date of sale, which is 158,000. It'll give me the accumulated depreciation of the remaining assets, which includes the new asset at the end of the year. So I've got 688,000 plus 225,500 minus 158,000. It gives me 753,500, which is my accumulated depreciation. So to get my carrying value at the end of the year, I will simply take that cost price of the remaining, including the new, minus accumulated depreciation. Um, and that'll be 1,700,000. You minus 753,500. It will give you 946,500. Was that the last question? It looks like it was. That's it. It's actually nice to do unprepared questions. Kind of enjoy it. Normally, I do the question twice. So the first time I do it, it's when I'm typing it out. That's when I'm answering the question. And and then obviously I have to record it, which is the second time where I have to re-explain what I already did. But this one is it's a little bit quick and easy because here I don't have to re-explain, I don't have to type, I just go straight to it. I hope you are enjoying it like I am. All right. Thank you guys for your support. Thank you for these questions because I get them from you guys. Please don't forget to subscribe, let your friends know about this channel. And if you would like us to have a lesson, please check the description. I've explained where you can find me. If you need one-on-one lesson or if you need online lessons, just go to the description. The details are there. Right? Thank you again. Ngiyabonga. Ndolebua. Thank you guys.